And it's 10 a.m. right here in Lagos, Nigeria. Definitely the midweek trade and definitely markets are buzzing right now. Hope you're on the right side of these trades. Let's get a check on the oil market now. We're seeing oil prices, they've plunged nearly 15% today after U.S. President Donald Trump agreed to a 2-week ceasefire with Iran and said Washington would help ease shipping congestion in the Strait of Hormuz. We're seeing the impact right there on oil prices. The futures expiring in June, that declined nearly 14% to about $94.34 per barrel, while US WTI, that was trading, that slumped about 15% to about $95.91 per barrel. We still have that premium there between WTI and Brent. It's a rare, it's a rare moment in the oil market when WTI gets, more expensive than Brent, and we're seeing that, continuing, even though prices have dropped a lot. And, at this point, so much volatility that was expected this week, and now we are sub 100 at this point. Hopefully, that translates to lower prices at the pump there, and maybe reduces the pressure on consumers. So that's what's playing out in the oil market. Now we'll drill down later on in the show on what's driving sentiment and how to, navigate that trade. All right, let's get a check on the local bourse now. The close yesterday, the market hit another major milestone with Nigerian Exchange Limited crossing the 130 trillion mark that's for market capitalization. The rally comes after 209 billion gain in the single trading session, driven largely by renewed investor interest in blue chip and fundamentally strong stocks there. 202,000 for the NGX All Share Index, 0.16% higher. That's a trade right after Easter celebrations there. So we're seeing investors there rushing in. Let's get a check now on the top gainers. We see Omatech, Cadbury on the top gainers chart there. If we look at the trading activity, also we see there was a lot of volume traded, value about 40.28 billion, deals 78,006, and we see volume of trades about 1.15 billion. So good numbers right there, giving us indication of what to expect for the market this week. Meanwhile, Nigeria is back on the global investment map as FTSE Russell officially upgraded the country to frontier market status in its latest classification review. The move follows months on a watch list and marks a significant shift from Nigeria's previous standalone position. The reclassification is expected to trigger fresh inflows into the Nigerian exchange as global index tracking funds and ETFs are now required to reallocate capital into key Nigerian stocks, including MTN Nigeria, Dangote Cement, GTCO, and Zenith Bank. We see President Bola Tinubu is set to attend the 2026 Africa CEO Forum in Kigali, Rwanda, as part of efforts to deepen economic engagement across the continent. The forum, scheduled for May 14th to 15th, will bring together top business leaders, investors, and policymakers to discuss Africa's growth, investment opportunities, and regional integration. This year's discussions will focus on scaling African businesses and boosting cross-border collaboration to drive economic development amid a rapidly changing global economy. Then we see the Nigerian Economic Summit Group. They say Nigeria's business environment remained in the expansion zone in March, but with weaker momentum as the Business Performance Index that dropped sharply to about 101.2 points from 117.2 points in February. Performance was mixed across sectors, manufacturing, trade, and services all expanded, but at a slower pace, while non-manufacturing and agriculture, that slipped into contraction, signaling broader weakness in economic activity. The slowdown reflects persistent pressures on businesses, including limited access to finance, power supply challenges, insecurity, and high operating costs, which continue to weigh on investment and overall productivity. And a report by the World Bank shows that the nation's economy has recorded moderate growth, though with inflation and the crisis in the Middle East constituting a major concern. Speaking during the presentation of the Nigeria Development Update in Abuja, the World Bank Country Director, Mr. Matthew Fergus says sustaining reform momentum remains critical to consolidating stabilization gains and boosting inclusive growth amid pre-election pressures and global uncertainty. Our correspondent Sarah Echimigo reports.
The biannual Nigeria Development Update of the World Bank is bringing together top government officials, development partners, and members of the private sector. This time, the focus is on early child development as the country director of the World Bank gives highlights of the nation's economy, raising concerns of high inflation on the one hand and increase in fuel prices, leading to rising cost of goods and services.
There is a deadline to end the war today, you probably have all heard. But even if that were to happen, if the war was to end today, it will still take some time to overcome the disruptions. And if the war continues, the impact, and especially on inflation, are difficult to project.
According to the report, 110 out of 1,000 children die before 5 years, while 40% of the figure are stunted. 52% are not developmentally on track before entering school. These figures formed the basis of discussion on how to address early childhood development.
The challenges are especially severe for poorer households and in northern states. These numbers, for a country like Nigeria, with Nigeria's aspirations, should be treated as a crisis.
To achieve faster and more inclusive growth and to accelerate the creation of more and better jobs, Nigeria also needs an empowering and enabling power sector.
Issues of macroeconomic stability, fiscal reforms, and how state governments are addressing concerns that borders on the economy and early childhood development were answered.
The way we are going to substantially lift millions of Nigerians out of poverty is by investment. Yes, the government has its own, what the World Bank called enablers, pillar investments, but it is Nigerians, not just the large scale, but the small and the medium scale, whose investments will help us to create jobs and reduce poverty.
To ensure that we open up the taps, to ensure that Nigeria gains that. And that really is what is showing, not only in the stability in the market, but also in the external sector. If you look at the current account balance, the financial accounts, we're doing really, really well.
We need to begin to look at early childhood development as a core, core value in our economy. It also contributes to economic growth of the country.
The World Bank states that out of 200 million Nigerians, about 82 million are under the age of 14, a demography that the banks believe can become an engine of prosperity and inclusive growth if the right economic policies and early child development initiatives are taken seriously. Sarah Chimugu, Channels Television News.
All right, now to our first conversation. Nigeria's business environment is still growing, but momentum is clearly slowing. Latest report from the Nigerian Economic Summit Group shows the Business Confidence Index dropped sharply to 101.2 points in March from 117.2 points in February 2026, signaling weaker expansion, even though we're still above, the expansion level. Also hot today, President Bola Tinubu has approved the implementation of Nigeria's 2026 fiscal policy measures, introducing new tariff adjustments and excise duties. The policy supposed to take effect April 1st, includes levies on beverages, tobacco products, and a new green tax surcharge as part of efforts to align with regional trade frameworks and boost government revenue. We're going to unpack all of this now. And the best brain to help us with that right here, Mr. George Walker, the MD CEO, Coleman Wires and Cables, is joining me right here in the studio. It's great to have you, sir. Good morning.
Good morning.
Always expecting your comments on these matters. And we're going to analyze the first quarter of 2026. It started off quite rosy, January to February, we all had our projections, for the global economy, for the Nigerian economy, and for major commodities. But that flipped towards the end of February. coming into March. And now we're seeing the data from the NESG showing slower pace of growth. Definitely, it's because of what played out towards the tail end of February into March. So it was expected. It was a no-brainer. March would be tough. And there's a saying there: "Beware the Ides of March." Finally played out, in this quarter. Talk to me about this new data and how it really felt, for you.
In every circumstance, when you look at it from the perspective of manufacturers, business and life is dynamic. Now, when something is dynamic, you also have to expect the unexpected. The unexpected is the impact of the Israel, US, Iran war. That changed every dynamics changed the sense of direction of where everybody in the world believed 2026 direction was going. From a business perspective, it was a shock the system literally did not expect. We were not planned for, but the impact was greater within the last 6 weeks than everybody could ever think for. Oil prices went skyrocket. The Strait of Hormuz became a toll gate. Highest bidder who crosses, who doesn't cross, who's your friend, who's not. And I think the dynamics of what has happened really now is we're all readjusting to the unexpected. So, of course, the figures that we see, literally purchasing index going down, was meant to happen, really, when you look at it. Look at today, the price of petrol, diesel, the price of gas in the world, the price of importation cost went up. Some of our goods literally went up 40–50% overnight in terms of raw material cost. And some of it was due to Iran supplying some Chinese firms that literally lost petrochemical availability immediately. That happened. So they needed local sourcing prices went up, indexes changed, inflation changed. If you look at it, by January, the whole world saw an easing. Every central bank in the world was easing interest rate. All of a sudden, everybody's stalling on interest rate. Now they're thinking of raising interest rate. So invariably, the businesses are taking a shock. They're taking a hit from external factors. The Nigerian factor today, the Nigerian scenario, literally we're taking a hit from what we didn't plan for. And so sometimes it's easy for us to point easy positions on people or certain situations, but really it was inevitable, and it has happened. But I think Nigeria has been better placed to handle such a shock than we have ever been. We have the Dangote refinery and other refineries, modulars. Major advantage of that is that some government policy, fiscal policy went right. 2 years ago, Naira for crude. That was a game changer for us, really. So the impact of Naira for crude with those petrochemical companies in Nigeria are seen as having an impact, but not the same type of impact. If you look at the rest of the world, there are queues everywhere. They're rationing everywhere. We're all driving in Nigeria and literally be able to drive in and drive out of petrol stations because we changed the dynamics.
Even though we're driving and drive out, some of us drive out sad because our disposable income has been hammered because of the price increase.
But the good thing is it's all temporary. It's not long term. The shocks are not shocks that we all don't see reversal. Just look, simple announcement of a ceasefire tailed crude oil prices below $100 for the first time. And that just shows you that, look, whatever glitch we're seeing, yes, though we see long-term impact, but there will be also immediate reliefs that would happen. And that would change the quarter that we're seeing, and future quarters could be better. Yes, we might not get the immediate next quarter, which is where we're in now, quarter two, being the best of the best. But literally, if this easing issue, external forces actually start easing, then we'll actually see some benefit. But take it irrespective. Nigeria's macro policy has played the right part. CBN has done it. Now, invariably, just as you said, Now we've got the Nigerian fiscal measuring tool of 2026 finally done to rebalance, two aspects of economics, macro, micro. Macro being your monetary policy, which literally you should applaud the CBN for whatever they've done in the last 2 years.
And now we're seeing something coming from the fiscal side, but we're going to get into that,
Correct.
Definitely. But I still want to pick your brain on Q1 because there's a saying about the first quarter. It said it has a way of, guiding the other quarters, of the year, and seeing how turbulent it's been, so far. What would you say were the goods, for your industry, in Q1? What improvements did you see, this year, and what do you see, going into Q2?
I think for most industries, especially my industry, we've seen the upside. I've seen increase in business. We've seen positivity in bottom line, and where we see it, because look, if you look at what has happened over the last 2 years or last 3 years, there's been a deliberate attempt to reposition Nigeria for the growth we're in. If not for this blip, I think everybody was going to be smiling in 2026 because all we saw was, especially in January, we saw a rise and we saw consumer spending actually improving. And I always say, look, cable industry is the statistics of growth in Nigeria because 15% of every infrastructural spend is cable. So when we see increases, we'll see it first. And we saw increases. We saw spending increases. And when you see it, because by the time you look at the clientele coming in, I saw more increase in oil and gas spend. We saw more increase in infrastructural spend. We saw more increase in factory spending. And the type of volumes these factories or investors were investing in. Because when someone starts asking a certain volume of cable, you can predict the total size of the project itself. And those are the type of volumes I've seen this year that has increased from where we are. And if I look at it, I'm saying for me, I see a year where it's a minimum of a double the turnover type of year for us. And if I can see double the turnover, and I didn't see it in the last 2 years, it seems capacity utilization is going to be increased. Utilization in every factory will be increased. And therefore, that turns into something else, which is positivity. Now, blip or no blip, it's 250 million Nigerians. Something is going right. It has to happen. And that would actually change things for the better. Because it's that spending you need to happen. If the spending is not there, then all of us will be contracting. Now, we're contracting in March because of a blip. Of course, cost went up. You have to readjust. How do you deal with it? Now, for us, the prices are stabilized. We saw a copper price increase to almost $14,000 per ton. That was a shock to the system for anybody because we've never even seen 12 until December in the history of commodity pricing. Now we saw it $14,000 copper, but now it's eased. Technical corrections will happen over time. Now we've got about 12,700 to a 13,000 mark where the surpluses and the balances and the market is readjusting to technical issues. Now, when you look at that, if it's happened in our industry, it's happening generally in most industries. And what you also should see, and this is the positives also for us, is that interest rate is tailing down. Even as we see issues around the world, we're not at the heights where people are borrowing 35% anymore. We're all now at the mid-25s, and it's coming down, and it's still coming down. So recapitalization of the banking industry, I saw them more buoyant. They're borrowing a bit more now. They're lending at better pricing because the cost of fund has changed for them because now it's equity rather than lending or borrowing. So a lot of things have changed in itself that has crystallized now for the banking industry that we have all been seeing the benefit because some of those banks made their cutoff by July last year. And so over time, you started seeing benefits to the industry. And at the end of the day, it's going to end up being passed on to the consumer because if my cost of sale comes down, of course I want to sell more. I'll bring my pricing down to increase my turnover.
Right.
Because bottom line is still better.
And it'd be great to see, more prices, come down and less profiteering from some, producers at this point. All right, let's get into the fiscal side of things. You did mention you've seen some positives there on the fiscal side, and we did see that there's a 2026 fiscal policy there. I see some negatives, but fine. If we look at the data snapshot there, we see policy type is fiscal, trade, and tax reform. If we move to the first one, that's a data snapshot. Effective start is April. Full implementation between 2026 to 2028. So it's going to be phased. Core objectives for this fiscal policy for 2026: revenue growth, import substitution, and industrial growth. Then we now see some excise duties being increased for the likes of alcohol, increased excise duties, tobacco, increased excise duties, sugary drinks, as expected, the sugar tax and all of that. Then for the industrial support side, we're seeing raw materials, import of raw materials, reduced tariffs there. Machinery, reduced tariffs. Chemicals, reduced tariffs. So I'm sure you like that.
Oh.
I've seen that.
Look, the good thing is, like we've spoken here about certain things I could not just phantom. There is no place in the world that wants to encourage direct investment, whether foreign or domestic, that literally is penalizing you for investing, which is what we're doing. You're penalizing people for importing machinery to create jobs. Who does that? Now, and I've argued this thing for years. Yes, we introduced import duty waivers. It became, I think, 10 to 15 years ago, you almost had to know someone to get it. Now, yes, under this current system, they've improved it a lot. It's technology-based. You apply online, you get your results. But at the time frame, but why should we go through that whole process, right? Now you've put it on the national list. Chapter 84, Chapter 85, Chapter 90, all zero. That is a game changer. And for me, I was so excited. If that one alone has been done right years ago, I don't think we'll be here where we are. So for me, I'll commend two people: the Minister of Industry, Trade and Investment, the two ministers, both for state, John Owen, and the substantive minister, Jumoke Odwale. Those two have done something the rest could not do for years. Literally fight the right policy. Fiscal policy is a balance of what your monetary policy is. You can have all the monetary policy in the world, but if you get it wrong on the fiscal side, you're making the other guy do hard work for doing less, but you will not see the impact that quickly. Now, you're going to tell people, you can bring in your machinery. You're not paying any duty for bringing it in. Nobody's penalizing you. The brilliant part is also gone on the national list. On the national list, that 4% under the customer is 1% under the national list.
So paint a picture for us now. Let's imagine you're trying to import machinery and you're paying XX amount.
Correct.
What do you pay on that before this?
Before this, you paid 5%. Now, if you get the import duty exemption, you get a 5% reduction. You get the reduction on the 5%. You pay 5% on the actual amount for a reduction on dutiable. But they don't waive that 4%. It becomes an issue. So that part, I don't understand it. Now, that doesn't work. Now, under this one, it goes into the national list for everybody that qualifies for backward integration, which is every manufacturer that has been certified for backward integration. You can move to Chapter 99. Under that, you don't need to write any minister. You don't need to write any ministry. You've got that certificate that allows you to import under Chapter 99 your machinery of Chapter 84, 85, 90. And that allows you duty-free zero. Under duty-free zero, the only payment you pay is the custom charge, which is 1% under Chapter 99. It's 4% if you're outside Chapter 99, which customs agreed with MAN last year, And that would help. So you have that advantage. So it changes the game. Raw material cost has come down also. Certain things have been done in certain areas, raw materials, chemicals, that will actually enable, some at zero, some at drop to 5%, also under those chapters, even on the normal trade tariffs. And what they've done is to enable businesses thrive, most likely industry. I think it's deliberate to actually say you want industry to grow, and once industry grows, you actually grow employment. So it's making it deliverable, at the same time making it possible for you to create jobs. And if you create jobs, the other revenue will come in, because whoever you're employing is paying payee. The company that is doing well is paying CIT, company income tax. So all this is, and you're paying VAT, it actually comes back into government revenue. Key part of it is also there's a twist to it. There's certain duties that have been gone, that's pushed up. Yes, in certain areas, they've actually pushed up those duties. But, you know, we get sometimes things wrong when we see duty or tariff increases. Tariff increases are there to rebalance tariff payables.
Right.
And those are done really to actually help businesses survive. If I don't place a 40% or 50% duty on certain importation, I would not create alternative local source.
And that's to protect, you know, the local producers,
Correct.
you know, at this point. But, you know, there's still that fear, you know, at this point. You know, when you see excise duties on things like maybe alcohol, tobacco, and some other, you know, goods that Nigerian consumers, you know, like, there's also that issue of the local producers meeting that demand. And we still have the same issues here. Electricity, definitely cost of doing business. I've had that issue with a tie seller. He told me it was cheaper for him to import ties than to produce ties here.
Correct.
It'll be great to see more production here. But are we doing it too fast? Do we find a way, a balance, you know, at this point? Because if you're looking at the possible economic impacts of this now, for the positives, local manufacturing, boost. Agriculture, boost. Government revenue, increase. There's also an FX demand there, should be reduced. There should be less pressure on FX. Then the possible negative effects, consumer prices will go up, you know, if excise duties go on some of these imports. That if it goes up, import businesses will feel the pressure, you know, of that. Then inflation, potential rise in inflation. So how do we balance this?
Can I knock that negative for you a bit?
Okay.
You know, sometimes we analyze things rightly and sometimes wrongly. In manufacturing, it's a little bit different. If you notice one thing that does happen, you will get a bit of inflation, but sometimes it gets absorbed into their profitability bottom line. Economy of scale comes in. If you look at in our beverage industry, both non-alcoholic and alcoholic, it's a volume game. You can't come into that market and be a small player and do well. You need to be a volume player, and that means you need to invest massively. Taking the last investment that even was publicized by Inaba for a $35 million beverage industry that was opened by the governor. And it's not something that is small, neither is it done in its low capacity. But when you also look at where they're penalized, it's a sugar tax, right? Which, let's be truthful to ourselves, anywhere in the world, diabetic issues has become a major pain in every place you're going. It's a big cost to most governments. And everybody now is trying to get us to be a bit more healthy. Let's be fair enough. But it must be slightly done. For Nigeria, it's not something you jump at and start charging people 50, 60 naira on. Where I see where the balance is, because we were against it at MAN, totally. And because we felt the beverage industry actually do employ a lot of people.
Right, and it also gets into the car import markets too.
Yes, that eventually, but also there's a rebalance. The EV is zero duty.
Yeah, for EVs.
Yeah, so that also has a rebalance. So you can't have total wins. What you do is like, how many wins did I get? If I get majority, I'll take it. If I get a minority, I'll flip and be complaining. Normally, This thing came out on the 1st. The industry literally has known about it in the last 2 days. If this thing really was that bad, I think the advocacy part of man would have been screaming hell and loose faster than you would have heard about it. But if you look at it, we got our wins. We'll look at our wounds in some certain areas, but we'll rebalance. But it's the majority wins we're all looking at. You cannot have, in anything you do or anything, there's no way everybody will be satisfied by whatever decision you make. Even as individuals, there's some certain decisions we'll make that it's not going to please everybody we like. And that's life.
Yeah, I can imagine the car lovers at this point because cars are really expensive
Yeah,
right now.
The
And
EVs are saying we now should go EV. You can charge a charging station will charge your car.
I've seen a few BYDs on the roads at this point. But
look, the government is encouraging one thing, and I'm not an advocate for, but sometimes when policies are done the right way, we need to actually commend them. I'm not a politician, I'm a businessman. So I'll scream when you're actually doing things that really are not helping me. But when you look at it, EV cars have been zero duty since the last 2 years. And it was there to just encourage people to move away from fossil fuel to actually EV so that the cost. And when you really look at the cars, go to China, which is the #1 in terms of production of EV cars. These cars, literally, you can get an EV car for as low as $7,000 or $8,000. Rightly so, it seems that certain car importers are still taking advantage because the volume or the competitiveness of the market has not achieved that level yet. And that's what I see as a because I've been to some of them and I'm literally querying why they're selling at some of the prices. Some are doing the thing the right way, some are still taking advantage. But in everything, competition will bring the right balance. And I think the more, what we see now is new players, other players. There's 150 EV car manufacturers in China. So I don't even think we've seen 10 of them yet in Nigeria. So I think the opportunities, and there are others in the world. So we're going to see better EV pricing. And as we get those EV pricing, we will get the cost coming down. And the reality is, if you look at the EV, most people charge their cars now for less than 8,000 naira. I have a friend, he was smiling every day. He's telling me, I charge my car for 8,000 naira.
When some of us are spending 70K to fill up
he said it lasts him.
Tanks.
And all it does is that he's checked his bill, he charges it at home, and it costs him 8,000 on his billing. So when you look at that, that gives you an advantage. The dynamics of business opportunities in Nigeria and in Africa is changing. The quarter has been what we seem to be in the right direction. The interest rate is in the right direction. The positive vibes that we're seeing is still there. Yes, we're in an election year, but I see it also as a growth year because spending on infrastructure is more, opportunities for business, for people to do more is there. And the reality is, look, take the spending power that is a shock and blip based on external factor, not a Nigerian factor. It's short-lived. I believe it's going to be short-lived. We might feel another quarter of it, which is quarter 2. We'll start seeing the easing by quarter 3, quarter 4. And if we get that, which we would get, Nigeria will see what we were expecting to see. And that's the positive end of the harsh realities we had to face.
Right.
Immunize everything, immunize FX, immunize, remove subsidy, and see the spending. We're now seeing the benefit. Look, one thing I said even here some years ago, 2 years ago, was, look, the hardest decision had to be taken by whoever got there within the first 1-2 weeks. It was taken. But I said that it will take that person, whoever is in government, 3 years to actually show the benefit.
All right.
And we're now going to see the benefit.
All right. I guess we'll still keep tracking, and hopefully we all feel more, of the benefits going forward. Always great having this conversation with you. Thank you so much, sir, for helping us unpack all of these matters, and definitely we'll be analyzing this document, as time goes by. Thank you so much, Mr. George.
Thank you for having me.
As the MD CEO, Coleman Wires and Cables. Thank you for coming on today.
Thank you, laddie.
All right, we'll take a break now. When we come back, we'll get a check on the star commodity, oil. What's happening? That's in a moment. Just stay with us. Obviously, Nigeria's oil sector maybe entering a new phase of growth, with the Nigerian National Petroleum Company Limited unveiling the new crude grade as Cawthon blend and successfully exporting its first cargo of about 950,000 barrels to the Netherlands. This marks the first crude export from a newly developed terminal in nearly 50 years, powered by the FSO Cawthon vessel, and signals a broader push to expand production capacity, improve infrastructure, and boost revenue in the upstream sector. But beyond the headline milestone, the key question is whether this translates into sustained output growth, stronger FX inflows, and real structural improvement in Nigeria's economy. Joining me now to unpack this, Mr. Jide Pratt, the country manager, Trade Grid, Chief Operating Officer, Iona, and an oil and gas professional, joining me right here in the studio. It's great to have you, sir.
Thanks,
happy post-Easter and everything else in between, and de-escalation today. Hopefully no escalation.
Hopefully.
In a few minutes in the oil and gas industry. But first off, let's kick off with what played out this morning. We got de-escalation as expected. Oil prices, boom, below $100 per barrel. Is it time to celebrate?
So no. In every situation of war or chaos, there's normally a calm, and then there's a storm. So we've experienced a lot of storm for quite a while. I would use the word that reasoning seems to be taking the front stage now. So there's a 2-week window. And in this 2-week window, the first thing that you realize is, like you said, prices will start to dip. And that is happening because traders who have paper are going to let their paper go. So why are you holding on to stock when there's some relative calm for 14 days? That said, is it something we should be happy about? At the moment, yes. So let's take the win. What I'm still worried about is how sustainable is this win going forward. Sadly, on the side of the US, I'm not so sure that there's been a lot of good wind energy. It seems to be that the president, POTUS, has just taken a step and decides this is how we're going, regardless of how it affects anybody. If that calm continues, then we can get to some relative stability. Then, like you said, we can begin to celebrate and say the worst is behind us. That's how I'll put it.
And talking about celebrations now, 950,000 barrels of Cawthon exported to the Netherlands. The oil type, it's light, it's sweet. At this point, what's this milestone, for us?
A major win. So when you look at it, that as a country, we know that potentially we can do 2.5 million barrels a day. We haven't been anywhere near that in quite a while. If you look at the last set of OPEC reports, even though there was a blip at the time where we got to 1.8, we seem to be hovering around 1.4, 1.5. 950,000 barrels of this grade of crude oil is, and again, it's sweet like crude. The API
like
gravity,
Bonny Light.
like Bonny Light, because the API gravity is about 36.4, if my memory serves me right. So 2 things on that end. It means that if we're able to export it, rig counts are getting higher. If rig counts are getting higher and production is getting higher, it now means that on a balance of play as a nation, there's more revenue from crude oil in terms of export. But it also means that at this time we need to sit down and look at it. How do we also feed effectively and efficiently refineries that are local? The balance of this play has to be, as we get more crude oil, as we begin to export in terms of revenue, we must also begin to continue to refine, because like it or not, we've become a refining hub, as the case may be with the super refinery.
Because when I saw the headline, in my mind, I'm like, okay, Dangote refinery and other refineries, they need feedstock. At this point, and sending out 950,000 barrels to the Netherlands at a time like this, it just seems counterproductive-ish.
Valid point. So look at it this way. If there's a strain on revenue, then it means that they will sell that 950 to shore up fiscal or federation account. That's a 1. I do agree with you in terms of, which is why I said if this happens sustainably, don't forget that in 2024 and 2025, the NNPC released 2 different crudes. I believe it was Obodo, and then there was another one, Otapate. So they've done this since 2024, 2025, and now. So what needs to happen is that those figures need to become sustainable, not flash in the pans. And again, I had said this earlier, it means that we must balance what is going out as export for federation account and what is being retained, because it doesn't make sense if you have refining capacity of 650,000 barrels plus X, you can't feed the refineries efficiently, and then we're making so much money, quote and unquote, on export. What needs to happen is that balance where, you remember there was something called the domestic crude supply obligation. It hasn't died. That was one of the reasons that the government in place came on with the Naira for crude. So the question is this: if we're seeing increment, there must be a coefficient where if X amount is going as export, so and so amount is retained and fed into the local refineries. And that way you find a refining capacity, while on distillate, as a nation, the refineries make money. In terms of supply or security, it's guaranteed. In terms of timing, it's also outside export channels at that pace. I think that balance must be struck.
Right.
It must be struck.
So at this point, that's good for revenue.
Yes.
But also there should be balance, for feedstock and all of that. So with this new development, we did hear that Bonny Light hit about $120 per barrel, but I'm sure with this drop,
come down a bit.
We'll see, a drop. So with all that's played out so far in an oil market with these grades, what do you think should be the next point of action for this, government and the managers of, this resource? Because with these high prices, we're not hearing much celebration about government revenue. It seems that's been, instead we're hearing more of, we have to pay more at the pumps.
It's a bit of a worry, and again, it comes to adequate planning. So the first cardinal point is that there's a direct correlation between crude oil pricing and distillate pricing. That's a fact. Now, the second thing is this. If we begin to earn in excess, so what was the benchmark for crude oil at the budget? It was $65 a barrel. If we're getting to levels of 110, like the 120, then whether we want to accept it or not, one thing that is happening is that federation revenue is increasing. Now, the accountability around it is what needs to be demanded at that time. Because the point is this: if you make 100% of what you had budgeted, that money has come into the coffers. So it means that, and don't forget, we're not saying federal government account, we're saying federation account. So it means that the states, the local government, and the center are, in terms of earning, they're earning more money. The flip side and the painful part is that, Ladi, when we go to the pump, because there's a direct correlation between crude oil and distillate prices, we're paying more at the pump. So the question I've asked in this period, and I mean government policy, maybe subsidy is not the word to come back to. But Ladi, if there's an open market selling price for crude oil, and then there's a premium, we now need to discount that premium to feed into domestic crude supply obligation. And it's very, very simple, so that we can cap prices at a certain level. So that way, while we're gaining in excess in terms of revenue, some of it comes back as a palliative in terms of road transportation. The alternative would have been to say, let's just move to CNG, let's move to EVs. But we're not there yet. It's a road to get there. So in the interim, if this insanity around Iran continues, then I think we need to be looking at what the federation account is getting. And how do we dovetail some of it back as a discount on open market selling price to feed local refineries.
We did see measures from some other countries,
yes,
cutting off tax and
levies
on some of these refined products. What can we do there?
I'm going back to what I've said, and this is what I think works for Nigeria. Most of these countries do not produce crude. So if you look at what has happened in places like Kenya, Kenya has reduced levies and taxes, but they're not a large crude producer. So go back to our own competitive advantage. We are a large crude producer. So as against taking taxes and levies off, yes, those could be palliatives. I think the real meat of the issue here is that if we're earning $60 extra, take a knife and cut it across. What goes into government federation account? What goes back as a discount in terms of crude supply to local refineries? Because that way, once you discount the crude, I mean the X refinery or the X gate price is also going to be discounted. give the crude that is required to who is required to, and begin to peg it. So if we say our daily use of petrol is 50 million, then peg it. So X refinery, X gate, if it is 50 million liters, then put it into vessels across hubs. The refinery brings it out, but I mean, instead of trucking it across the whole nation, send it into vessels. There are people who import it, there are people who export, and take it to hubs, regional hubs, Warri, Port Harcourt, Calabar. That way the distribution of that product is felt instantly. It's not rocket science. The guys in power really know what to do, whether they want to do it.
And we're seeing this big drop, 15% drop, in prices in the global market, expecting Dangote refinery to drop.
What has happened over the last period of 2-3 months, you find out that they've been very, very, not proactive, reactive. Immediately the market moves, they cut prices. So what you find out is that because we don't have a pricing window system, prices change on the day. Ladi, what should happen ideally is that every time crude oil prices go up or down, your batch is what we need to look at. When did you receive this crude? When did you refine this crude? So if you had stock in tank and your payments are deferred for 30 days, then what it means is that you should be applying the payments at the pumps or at X gate based on what you refine backwards, not forward. But what the refinery seems to be doing is just anticipating on the jump. And every time there's a jump, they increase. So I assume that in this stage now, they should come back a bit and say that, okay, if this thing has dropped, because they've been very fast on the increase, I think that same proactivity needs to go into the decrease.
Right. We need to see that same energy.
I think so.
Prices don't stay sticky. Oppo, thank you so much. Mr. Jide Pratt, Country Manager, Trade Grid, and also an oil and gas professional. Thank you so much for coming on the show today. And definitely we hope de-escalation continues.
Thank you. Thank you, Ladi.
All right. Now we're going to be, we'll take a break now. When we come back, we'll find out what's happening in the global space. That's in a moment. Just stay with us.
Okay, so now it's time for global news, and we would like to tell you what's going on. But first, we're going to start with an overview of Tuesday's trading session on the world's biggest economy, that's the United States, where we saw about a mixed result and amid the significant volatility. Yesterday, we saw that the Dow Jones Industrial Average was in the red, but our Washington correspondent, Maria Bird, tells us more on U.S. stock markets trading figures for Tuesday.
The U.S. stock market had an up and down day on Tuesday as the Dow Jones was able to close up at 0.2%. The S&P 500 and the NASDAQ were able to close slightly above flatline at 0.1% up, as many investors were watching the president's announcements around the war between Israel, Iran, and the U.S., specifically around his announcement that the 8 p.m. deadline would be enacted. As the investors were also hopeful as they saw that Pakistan made an announcement in a plea to the U.S. to extend it for another 2 weeks to open the Strait of Hormuz. As the president has not yet responded in regards to that, but there's much hope that the U.S. stock market is able to rebound over the next few days and weeks ahead, especially as the U.S., Israel, and Iran try to reach a peace agreement.
Our Washington correspondent Maribert giving us an overview of U.S. stock markets trading performance for Tuesday's trading session. So now, let's talk about European markets. Still with the markets, European markets as well as many other global markets are in the green. European markets starting first, they're opening sharply higher today as global markets breathed a sigh of relief after the United States. Of course, our Washington correspondent Mario Bird mentioned that they've reached an agreement which they call a win in between both countries for the opening of the Strait of Hormuz, as well as some 10-point proposal being made by Iran, as part of the agreement in between the two countries, which has, of course, caused lots of ripples across the global economy, from the commodities market to the stock market, as well as other major economies, including Nigeria. Now, the autos, miners, and travel stocks were the ones that led the gain, rising 5.8% for both, and then 7.3% accordingly. So, however, a number of Middle Eastern countries continue to report incoming missiles and drones, despite a disagreement between the United States and Iran. That's early today, and that's triggering air defenses across the Gulf. So it's still a kind of like a pensive mode for the Middle Eastern region, but we'll see how it turns out in the course of the coming days within the month of April and forward. Now, from there, let's go over to Shell, which is expected to report a significantly higher profits from its commodity trading desk in the first quarter of this year, after weeks of market volatility, which has been triggered by the Iran crisis. Now, the Europe's biggest oil and gas producer is also expecting lower gas production for the first quarter compared with the final quarter of last year. That's because of the impact of the Middle East conflict, which is affecting its assets in Qatar. While oil and gas markets, they recorded their historic price rises after this ongoing war, which caused lots of retaliations in between the Gulf neighbors against Iran, as well as Israel and U.S. pounding that country. So much more has been happening within that side of the world. Now let's move over to India, where we see the country's central bank. Well, after maintaining or keeping their interest rate unchanged at 5.2% in line with economists' forecasts, they're also warning that the impact of the war in between the U.S. and the U.S. and Iran might affect the country's inflation, driving it higher, and then is also threatening their growth. So currently, the Reserve Bank of India has lowered the country's real GDP growth for April to June, that's the second quarter, to about 6.8%, down from 6.9%. And for this July to September quarter, they're expecting a 6.7% growth compared with a 7% earlier forecast. Well, so far the country has seen sharp growth and continues to be the world's fastest growing economy, and currently the world's fifth largest economy. And from India, we move over to the UK, where we see the house prices have fallen. They fell last month. That's due to uncertainty surrounding the ongoing, much talked about U.S.-Iran war, which has dominated better part of the global headlines since the last day of February down to this is April. So about almost 40 days now that the war has been ongoing. So far, the results, according to Halifax, says the price of a home slipped back from £300,000 to £299,667 after first crossing the milestone in January. Now, Halifax said the uncertainty over the conflict in the Middle East has dampened the initial momentum in the market and seen the start of which was seen in the start of the year. Now, the choice of mortgage for home dealers shrank in recent weeks, with hundreds of mortgage products pulled from the market. So that's it for global news, and we'll have more on Thursday.
All right, thank you so much, Anete. So a quick check of the markets now. The NGX in the green, Zenith Bank, UBA, Fortis Global getting attention from investors. Oil still down, gold up, Bitcoin up. Bring you more updates at 1:30. I'm Lade Williams. Bye for now.